I'm Joshua Roberts of Biz News, and with me today for today's market insights is Counterpoint Value Fund Manager Piet Viljoen. Piet, lots to talk about as per usual. Remgro with an interesting deal regarding CIVH, one of their holding companies, and Vodacom. Have you had time to make sense of it?
I've had a look at it, so I'm not. I think it's not it's a complicated transaction. One will have to spend a bit more time on studying it than I have had time to do so far. They only announced it yesterday. It's interesting. I think it is the way of the future, but it is also a very capital-intensive business. And I'm not sure what the long-term returns on capital is in that business. One would have to see, but I think it's premature to make any firm comment on it at this point. I'm not in a position to do so.
I just spoke to Remgro Chief Investment Officer Peter Ace. I was asking him about the sustainability of the demand for fibre, especially from a household perspective. Do you think that more and more people will continue to go back to the offices, and this new normal will be something that subsides with time?
I think it's going to be a mix. I think it's too early to say, but I do think that there has been some behavioral change. In other words, you probably spend some time at the office and some time at home. But there is no doubt that there will be increased demand for fibre nationally, whether people go to the office or not, because more and more items will be connected to the internet. Household items will be connected to the internet. I mean, everything will be connected. And one needs high-speed fibre to operate those things efficiently. So I think the demand for the product will be there. I don't think demand is the issue here. It is, what is it cost to put in, and can you earn a return on that capital cost? That's a key question, which is not clear to me yet at this point.
Swift change to what's happening in the US. Inflation numbers out yesterday, scorching hot at 6.2%, a percent higher than our inflation here locally. Piet, can you just tell us what that means for growth stocks versus value stocks, and why it might benefit one and not good for the other?
So the theory goes, and again, the future is uncertain, so this is not a forecast, but the theory goes that growth stocks, and specifically tech stocks, are valued by discounting all their future cash flows by a discount rate, which is linked to the interest rate. And the lower the interest rate is, the higher the present value of those cash flows is. And value stocks are also valued that way. The difference is value stocks cash flows all sit in an immediate future, and most value stocks don't have a long runway of growth ahead of them. So you're only discounting 3 or 4 or 5 years worth of cash flows. Whereas with a stock like Microsoft or Apple, you might be discounting 20 or 30 or 40 years of cash flows. And if you do that with a low interest rate, it gives you a big present value. If that interest rate were to increase, however, it brings down that present value quite dramatically. Whereas with a value company or value stock, where the cash flows are right here in front of you for the next few years, any change in the interest rate that you use to discount those cash flows make almost no difference to the present value of those cash flows. So that's, so the theory goes that growth stocks are highly, the value of growth stocks is highly linked to interest rates. The lower they are, the higher the value of growth stocks are. And as interest rates increase, all else being equal, the value of those stocks, or valuation of those stocks might decline. It's too early to tell whether that's going to work out in practice, because interest rates have not really gone up, despite inflation in the US being at 6.2%. Long bond yields, 10-year yields in the US is still at 1.5%, and short rates are still hovering around 0. So inflation has gone up a lot. It looks like it's not transitory, but interest rates are still at grassroots levels. So, that theory has not been tested yet. It's too early to say.
Yeah, very interesting to see what the future holds. Also with these supply chain disruptions, see if that becomes a thing of the past. Let's just turn to the mining industry for a second. Lots happening there. Royal Bafokeng, the subject of lots of corporate action. It is all a bit confusing. Can you simplify it for us, Piet?
So I think what's happening here is that there is a fight for resource. I think platinum companies see the need for the metal they produce increasing over the long term. Impala has a reasonably short life of mine. whereas RB Plats has just developed a couple of new mines. They have a longer life, more reserves, and I think they lie adjacent to Impala. In fact, Impala mines on RBP ground. They're so close to each other. There's also issues with the smelters. There's capacity there. So there's lots of synergies between Impala and RBP, whereas Northam, there's no synergies, but I guess they just want to use the cash they have on hand on the balance sheet because they've been generating a lot of cash, like all the platinum companies over the past while. So it seems that they just want to stop Impala from getting hold of RBP, and they've taken out Royal Bafokeng Holdings stake, 32% stake of RBP. That means they don't have to make an offer to all the other shareholders, which leaves them out in the cold. So it's a very interesting situation developing there. I do think that the signs are starting to happen. It's still early days yet. It's not there yet, but the signs are starting to happen that with this corporate activity heating up in the platinum sector, that maybe valuations are starting to become a bit full. But as I said, I think it's still early in the cycle. It's not yet top of cycle. It's but we're closer to that. I would say we between 9 and 12 o'clock rather than 6 and 9 o'clock. That's how I would describe it.
Purple Group out with results. Piet, I know you don't write off any company on the JSE, no matter how big or small. Got a huge retail investor presence. Is this something that you look at? And then from a brokerage perspective, is this kind of a business you like to invest in?
I think it's a fantastic business. It has made investing in the stock market accessible for a lot of people. It's made it easy, and Easy Equities, the name of the business, is great. They're trying to do the same with property, which I think is fantastic. So what Charles Savage and his team has achieved there is fantastic. The problem I have as an investor is that at $250 a share, I think you're paying for a lot of what they still are going to be doing, which I think will be good things over the next few years, but you're already paying for that. So I don't see a value in the business, in the stock market price. I see it's a highly valuable business. It's a great business. I'm not sure it's a great investment at this point in time, but that might change in the future. Let's see what Charles and his team does. They've achieved a hell of a lot in over the space of the past few years, and I think they still have a long runway ahead of them. So good business, great business, in fact. Maybe not such a great investment, but time will tell.
Retailer Foschini also out with results, much improved, although versus a very low base of COVID last year.
Yeah.
Is this a company you follow or have an opinion on? I mean, discretionary retail in South Africa is a tough industry to be involved in.
I have an opinion on a lot of stuff. My opinion just might not be worth very much.
Tell us anyway, Pete.
So I do. so again, I think the Foschini Group is a good business. It's a well-run business. It was early getting into online sales. It did the least bad offshore transactions of all the retailers. So I think it's a good business. But again, I struggle with valuation. I'm a value investor, so I like to buy around for 50 cents. And in the case of a company like Purple or Easy Equities, I think it's a great business. But you're paying 150 possibly for rands worth of value there. Where Foschini Group, you're probably paying a rand for a rand. So you're getting, what you pay for, and there's nothing excess in there. So again, it's not something I would invest my clients' money in at this point in time. But I'm keeping eyes on it because I think it's a good, well-run business, and maybe one gets an opportunity at some point.
Lastly, Ascendis activist investor or representative Harry Smit was added to the board or appointed to the board recently. Is this a win for retail investors or simply a once-off?
Well, what does a win for retail investors mean? Are they going to make money out of Ascendis? Well, from where it's come from, they're losing money. Hopefully, going forward from here, they'll make money. I think the strategy is sensible in what they've done. They sold the offshore parts of the business at, I guess, a reasonable price. So the reason why Ascendis is where it is isn't because of current management, and it's because of the previous board and previous management who massively overpaid for mediocre assets using debt, and that got the business into trouble. And Mark Sardi and his team did very well in cleaning up that mess. So it's a tough job. And from here on forward, I think if they do the sensible things, minority shareholders could make money out of it. It's possible.